All right, it's 11 o'clock. I'm going to be punctual here and get started. So welcome everyone to the Lumsden and McCormick webinar, Planning, and More Planning, What's Necessary to Optimize Your Personal Financial Position. My name is Maria Gambacorta and I will serve as your host for the webinar this morning. Before we get to introductions, I wanted to run through a few housekeeping items. This webinar will be recorded and we will share a link with everyone once it is posted to our website along with the slide deck. And we anticipate that we'll have that done prior to the end of the week. So probably Thursday or Friday. And as you can see, both the chat and Q&A features have been enabled. If you have a general comment, you can put that in the chat box. But if you could put all Q&A into the Q&A box, we are going to hold all the questions until the end of the webinar. So as Cheryl and Bob go through their presentations, if you could put their questions in the question box and then we'll run through them at the end. We will be respectful of everyone's time and try to get this done in an hour. If you have follow-up questions, we're going to share the emails with everyone. You can find those in the chat in a minute, and you can email Bob and Cheryl directly. So moving on to CPE, we are offering 1 hour of CPE for this webinar. So therefore, all polling and survey questions need to be answered. We have 4 polling questions, and you need to answer 3 of the 4 polling questions to qualify for CPE credit. You'll be prompted for each, and we will share those results. At the end of the webinar, there is also a short survey. We ask that everyone please complete the questions. There's 10 of them, and that survey will serve as the webinar evaluation for the session today. And regarding CPE certificates, they will be mailed within 30 days of today. And the certificates are emailed from Polera, which is our email software, our CPE software. And I'm going to put that in the chat right now. And you might want to put that email address, support@polera.com, into your email so that it doesn't go into spam. And as everyone knows, this webinar is part of a 6-part series on legislative changes and accounting updates. So you can go to our website. I'm going to place the link in the chat if you want to access that other webinar events. You can do so, and here it goes in the chat. So you can join us for there's 2 in July and 1 in August. So now, without further ado, finally going to move on to meeting our presenters, Bob Ingrassi and Cheryl Jankowski. Bob focuses on planning strategies for businesses and individuals, concentrating on issues related to gift and estate planning and wealth preservation. And Cheryl has extensive experience working with business owners and individuals to minimize taxes with a focus on estate and succession planning. So I am going to actually launch the first poll prior to turning it over to Cheryl and Bob. So I'm going to launch that poll. If everyone take a minute to please answer it. And then, like I said, we'll turn it over to Cheryl and Bob. The first polling question is simply, are you attending this webinar to earn CPE credits? And we're just about almost at 100% completion, so we'll give that a few seconds. Okay, last chance. I'm going to end the poll, and then we'll turn it over to Cheryl, who's going to kick us off. All right. Great. Thanks, everyone.
Well, good morning, everyone. Thank you, Maria, for the introductions. So Bob and I have presented on some of these topics before, but we thought it would behoove us 6 months into President Biden's agenda, and we're seeing a lot of policy themes, and I think the biggest takeaway is that there's potential tax increases coming our way if legislation does pass. So we're going to talk about some general policy themes, some new tax proposals. Bob's going to focus on personal tax and the impact that these proposals could have and things to think about as we progress during this year. And estate and gift planning, there's a lot of proposed changes in this area and things to be considering as we move through 2021. So some of the general policy themes are increases on the wealthy, additional payroll taxes on higher earners. That's really focused on the Social Security tax, that 6.2% tax that wage earners pay on the first $142,800 of wages for 2021. Increased marginal tax rates. Marginal rates, Bob will touch on this, are at 37%, but for most of my career, I've been practicing for 30 years now. I've seen the highest rate at 39.6% for a good majority of my career. Increased capital gains rates on high income individuals, which Bob will chat about. Big area of concern is a reduction in the estate exemption and an increase in tax rate. And one of the things we've been chatting with clients about throughout the year is that there is some risk of retroactivity if these policies or if these legislation passes, that they may be effective as of the date the legislation was introduced. And there's a few areas that we'll highlight. One thing that is kind of interesting to note, I think most of us may have heard over the last week or so, there was a very big leak somehow from the IRS that ProPublica published the tax returns or where people, the amount of taxes that the wealthiest US citizens paid. And, that kind of goes along with this theme, kind of, getting people, incensed that maybe a Warren Buffett pays an effective tax rate less than somebody like Cheryl Jankowski. How could that happen? And so it's interesting that that was leaked prior to some of this debate on potential tax legislation. So let's look at some of these new tax proposals. We'll first start with the American Jobs Plan, and that was proposed at the end of March, and it's going to be paid for via the Made in America tax plan. You got to love the way these things are labeled. And it was a $2.3 trillion plan to invest in infrastructure. And part of the way that they planned on paying for it was increased corporate tax rates. Now, just a brief history of corporate tax rates. Now they're currently 21%. The proposal was to increase the corporate rate to 28%. And that 21% has just been, it's a flat 21%. And it was just introduced not that long ago with the Tax Cut and Jobs Act of 2017, and it was effective starting in 2018. So we're not even that far into this flat 21% tax bracket. And the reason for that lowering, because previously tax rates were from 15% all the way up to 35%. And corporate America would say that we're not competitive compared to the rest of the world, where corporate rates were less than what they were in the United States. So one of the themes was, with the Tax Cut and Jobs Act, let's reduce it down to 21% to allow our US corporations to be more competitive with these international corporations. We have a change in presidency, and they're looking to pay for some of this infrastructure with higher corporate rates. One thing I will share with you is, since this American Jobs Plan has been introduced, both Biden has scaled back, been willing to scale back the amount of this infrastructure investment, and the Republicans came in with a floor, and now they've increased the amount that they're willing to spend on infrastructure. Both parties agree that we need to invest in our infrastructure, our roads, our buildings. That's the things that we usually think of as infrastructure. Part of this plan also included something called kind of like community infrastructure, things that would support community-based care for elderly and disabled. Since then, they've scaled that part of the bill back. Biden is really focusing on, the transportation infrastructure. The Republicans and the Democrats have come together with an idea of about a $1.2 trillion plan with no corporate tax increases, because the Republicans are against that. And my understanding is that there is additional funds that have been unused from some of the previous COVID relief bills that would be used or earmarked now for this infrastructure bill. So it looks like there's negotiations. My guess is there probably will be something passed, but not with that 28% corporate tax rate increase. That's what we're hoping for anyways, because that would be that would be a huge rate increase for our corporations. Now, the American Families Plan, it was proposed April 28th, 2021. Now, that's an important date because Bob's going to mention what Biden has indicated that there might be part of this if this plan passes, which will be retroactive, seeing that we're at the end of June. The estimated cost of this is really the investing in our community infrastructure, so to speak, of 1.8 trillion in education and healthcare. And really what this is going to focus in on, and this is going to be what Bob's going to talk a bit more thoroughly on, is the goal is, how do we pay for it? Well, we're going to increase the tax on the wealthy. And how do we define wealthy? Well, each one of us would probably define wealthy in different terms, but Biden's goal is $400,000 annually of income, and it looks like adjusted gross income, which is not taxable income after deductions, where some of these increases might start to kick in if this bill does pass. Now we have another interesting proposal, for the 99.5% Act. So this is proposed by Bernie Sanders. So you can tell who's not the favored 0.5%, because this is who he thinks is going to pay for all of this investment in expanded social programs. And so Bernie's plan reduce federal and gift tax rates, or increase tax rates, reduce exemption amounts, increase income tax rates, elimination of valuation discounts, which we'll chat about in a little bit, introducing terms on generation skipping transfer trusts, also sometimes known as dynasty trusts. These dynasty trusts are not created under New York law. There's certain states that those are applicable under. There's a concept about portability, which we'll talk a little bit more about, but that's retained, which is actually a good thing. And so really it's the 99.5%. We're not feeling the love for the 0.5% Act is the way I would kind of dub that. And then there's even another proposal. So there is like the whole kitchen sink has been thrown in with tax proposals. And this one is even produces some additional concepts that we haven't seen Biden propose, but Biden has talked a little bit about it. Generally speaking, when somebody dies, the beneficiaries that inherit the assets receive them at market value as of date of death, and that there's no income tax ramification under current law for that increase in basis to the beneficiary that receives it. Well, this proposal, the Sensible Tax and Equity Promotion Act, is looking to potentially tax the unrealized appreciation that people have in their assets, in their portfolios. So I like to pick on Apple stock. Let's just say you bought Apple stock for $1 a share, and now you have a portfolio worth $5 million of Apple stock with $1 million of basis. Under this STEP Act, this Sensible Tax and Equity Promotion Act, you would pay tax on, you have almost $5 million of unrealized gain. The first $1 million, you would get a step up essentially, and then there would be a deemed disposition tax on worth $4 million that would be paid, which would be payable. Now, this is not a foreign concept to those of us that work with our Canadian friends, because up in Canada, they have what's called a deemed disposition tax. So this would be very similar to that, is that when in Canada, under current law, when somebody dies, their assets are deemed sold and capital gains are paid on that person's final income tax return. So this is a little bit of a new concept for us here in the US. I have not seen this proposed before. So this is something new, and it's gotten a lot of press because it is concerning that there could be a deemed disposition tax and an estate tax. That almost seems like double dipping, and we'll talk about how that double dipping would be mitigated in a little bit. So this is another way to raise revenue. So there's a lot of different proposals on the table. So as we go through this, it'll be an interesting summer to fall to see where this legislation goes. Right now, they're focused on first, that infrastructure bill is really what they're focused in on, trying to get that passed. And then I think once that gets passed, then Biden will be focusing on more of these social programs and how are they going to pay from them from the definition of wealthy, which is currently at $400,000. Our next polling question, number 2, how concerned are you about the possible rate increases? Very concerned, somewhat concerned, or not at all concerned? And Maria, are we?
One last second. I'm gonna end this. There we go. We got 100% voted. That's great. I'm gonna share the results.
So it looks like most of you are fairly concerned about tax rate increases. And yes, it could be very impactful as Bob starts chatting about personal taxes. So with that, I'm going to turn it over to Bob to talk about where we are currently and what is proposed out there.
Thank you, Cheryl. So as we can see from the very high level overview of the proposed legislation that Cheryl had just outlined, the majority of these changes are aimed at individual taxpayers to raise that necessary revenue to get these passed. So starting with individual income tax rates, as we know under the current law, the top marginal rate of 37% applies to when taxable income reaches just over $518,000 for single filers and just over $622,000 for married filers. So the American Families Plan has proposed that the top federal individual rate be restored to the 39.6%, as Cheryl had mentioned, when income reaches just over $452,000 for single filers and $509,000 for joint filers. It's expected that the same graduated tax rate schedule will remain, and taxpayers with income below these new thresholds really shouldn't see a rate increase. It should stay the same for those mid-earners and lower earners.
Bob, I'm just going to interject those. As you can see with those rates from 39.6% brackets, that it looks, what really is happening here is they're going back to the pre-tax cut and job acts rate brackets. That 37% bracket decreased from 39.6%, but they also increased the floor at which that new rate would apply. So they're going back, they're kind of just dialing back what the Tax Cut and Jobs Act provided for taxpayers.
So the net investment income tax, as many of us are aware, is a 3.8% on net investment income that's been used to fund healthcare reform over the past few years. When modified adjusted income exceeds $250,000 for joint filers, $125,000 for married filing separate, and $200,000 for all other filers. Just last week, the Supreme Court made a decision to uphold the Affordable Care Act as constitutional. So this additional tax will remain intact, and under the American Families Plan, it is proposed to be expanded, in which it will also apply to pass-through business income above $400,000. So previously, it was just on your investment income. now it could be expanded to be your pass-through business income as well. So with a top marginal rate of 39.6% and an additional 3.8% tax, our highest earners could be paying 43.4% federal tax on these portions of their income, which could be a huge jump for a lot of taxpayers. With regard to capital gains and dividends, as we know, under the current law, the top tax rate of 20% on long-term capital gains and qualified dividends applies when income reaches the mid to high $400,000 range. Depending on your filing status, the 15% rate applies for taxpayers with income under those thresholds. So one of the more substantial proposals within the American Families Plan is the elimination of the preferential reduced rates on long-term capital gains and qualified dividends when taxable income reaches $1 million, at which time that income would be taxed at the highest marginal rate of 39.6%. As Cheryl had mentioned, what's interesting about this proposal is that in President Biden's budget that was released at the end of April, it assumes that the increased capital gain rates have already gone into effect, essentially making this proposal retroactive. Of course, nothing is certain until it's signed into law, but there could be some substantial planning opportunities if this proposal is pushed back until January 1st of 22. So moving on to itemized deductions, as we know, the increased standard deductions put into place by the Taxpayer Cuts and Jobs Act remain, and those are set to revert to pre-Taxpayer Cuts and Jobs Act levels on January 1st of 26. Same with the elimination of the personal exemption and the $10,000 SALT cap. So under the new administration, it's proposed that the benefit of itemized deductions will be capped at 28%. As of right now, there's no indication how this limit will be calculated, but let's look at two potential assumptions on the next slide on how that might be done. So in this first example, let's assume a taxpayer has itemized deductions of $40,000. So under the current law, you can see that the benefit continues to increase as their marginal tax rate increases. If the benefit were to be capped at a straight 28% of the deductions, you'll see that as the marginal rate increases, the deduction value remains stagnant at 28% of $40,000. So there's no additional benefit once you get over that threshold. Looking at that small second example, perhaps itemized deductions would be reduced by a ratio calculation rather than the previous calculation. But you can see in this, the calculation doesn't produce a significantly different tax savings. So again, this could be a huge hit for many taxpayers if this is actually signed into law. So the $10,000 deduction limit for state and local income taxes, it's been a very hot topic for many years. As New York State residents, I'm sure a large number of us on the call have been impacted by this limit. Over the years, several elected officials have pledged to fight to have this limit repealed or have proposed higher limits, especially in states with high income tax and high real estate tax. I'm sure this will be used as a negotiating tool in getting some of these proposals passed once they actually get to that point.
And Bob, what's interesting is Biden is not inclined to repeal that SALT cap because it would be a very expensive repeal. And then his goal is to raise revenue. The SALT cap really penalizes individuals in high income tax states, but also high earners because they increase the itemized the standard deductions so much a number of years ago. So Biden is not inclined to repeal that state cap because it's just going to be too expensive with the social programs that he has proposed.
Right. So in response to the limitation on the federal side, although it's been several years since it's been enacted, a pass-through entity tax election has finally been included in the New York State budget bill for 2022. So this election allows New York State pass-through entities, which would be a partnership or an LLC or an S corporation, to voluntarily pay their New York State tax at the entity level rather than at the individual level. So by doing so, business owners will effectively receive an above-the-line deduction for the state taxes paid, which is not subject to the $10,000 limitation. And then the business owner could also receive a refundable credit against the New York State tax for their share of the liability paid by the entity. Again, avoiding the $10,000 cap for New York State purposes. This election for 2021 must be made no later than October 15th of 21. So we'll still have a few months to review individual situations, determine the best course of action for 2021.
And this was something that Carrie Rhodes and Mark Stack presented on last week. So we're going to be looking at this for our clients over the summer. It's going to make sense for most of our clients to be able to do this. It does add a level of complexity, of course, to the tax filings. However, there is a real benefit to be able to get your deduction on your federal return is the workaround. And New York State recently passed it, but there were other states such as Connecticut that had passed it previously, and it has stood up to IRS scrutiny as an allowable deduction. So that's good news for our pass-through entities. However, for those individuals that the SALT limitation significantly hurt, that has very high wages, currently, there is no workaround for that, but at least it is some relief for business entity owners.
I'm just going to interrupt real quick. I am adding to the chat right now the link to the recording for that New York State budget presentation that Cheryl referenced. I will add that into the chat as soon as I launch our third polling question here.
Thanks. So our third polling question says, have you reduced your charitable contributions in recent years?
You guys are quick this morning. You're answering this poll all under 30 seconds, so that's great. So thanks for everyone's participation. Give it just another few seconds. Okay, I'm going to end the poll and we'll share these results.
Thanks, Maria. So it looks like 75% of us have not, 25% of us have reduced them. And it's great to see such a large number still remaining consistent as they have in prior years. So that's the perfect segue into charitable contributions. So there are no current proposals specifically related to charitable contributions, but just as a quick refresher of the provisions put into place under the CARES Act, for 2021, individuals can deduct up to 100% of their adjusted gross income in cash contributions made specifically to public charities. The historical limits for gifts to donor advised funds and private foundations remain intact. Those are not 100%. There were no changes to those. Taxpayers who do not itemize for 2021 are able to claim an above the line deduction of $300 or $600 for cash contributions made, depending on their filing status. There was no carry forward for amounts contributed in excess of the $300 or $600, and this provision does expire on December 31st of 2021. And then finally, taxpayers are still able to satisfy their required minimum distribution from a traditional IRA by making a gift directly from their IRA to a charity. Although the RMD requirement was pushed back to age 72 under the Secure Act, this option remains available at age 70 and a half. So this really can be a powerful tool in either reducing your AGI for the year, reducing the value of your IRA, and still satisfying a charitable intent that you might have. And we always like to remind our clients that the Form 1099-R does not reflect direct charitable gifts made. So it is important to note this information to your tax preparer during filing season when you're providing your information to us. And then moving on to credits, the child tax credits will be increased to $3,000 for dependent children ages 17 and younger, with an additional $600 bonus for children under the age of 6. It's been highly publicized. I think it was in the newspaper today that the 2021 child tax credits will be advanced to taxpayers starting on July 15th. So you will not need to wait until filing your 2021 returns to receive this benefit. The IRS will be using 2019 or 2020 returns to determine if a taxpayer qualifies. So if you had qualified in a prior year, but you did not upon filing your 2021 return, the advance of that credit will need to be paid back. And then finally, the maximum child and dependent care credits will be increased to $8,000 if you have 2 children for 2021. So after looking at all of these proposals, some are very significant, some are minor. Where do we go from here? Especially with so much uncertainty on which proposals will pass and which ones will be shot down. In my experience, and I know Cheryl will have a great perspective on this too, regardless if rates are expected to increase in the future or decrease in the future, we as planners always fall back on these core planning strategies, which really come down to bracket management and timing of income and deductions. So for instance, if you're a business owner and you're concerned about the increase in the highest marginal rate or the potential for the net investment income tax on your business income, you might want to consider accelerating some expenses into the current year or making some large asset purchases sooner than you had originally anticipated. Or if you're a W-2 employee, retirement contributions and HSA contributions are a great way to lower your income if you're trying to qualify for certain credits, such as that child tax credits, because a lot of these do have an income threshold attached to them.
So Bob, I'm just going to interject with regard to health savings account. If you do have a high deductible plan, you can fund a health savings account and reimburse yourself for the medical expenses, but that helps reduce your adjusted gross income. Bob, did you confirm that that can be funded after year end up through April 15th?
Mm-hmm.
The way that if you get past the year end and we say, oh, you're phasing out of your child tax credit because your income's too high, that you're able to, after year end, contribute. However, if you are an employee in a company and you're eligible for a 401k, after year end, you're not going to be eligible to put money into an IRA. So it's important during the year to understand if you might be phasing out, where you, and if you're married, your spouse are overall on taxable income to see, or adjusted gross income to see if should you increase your IRA 401k contributions to help you be eligible for more child tax credits. So those are things you have to actually do now. And we're already halfway through the years, and you may have, depending on your ability to adjust your 401k contributions, it's not something that we can look in the rearview mirror and do after year end.
So then with regard to capital gains, if the proposal to eliminate the preferred rates is retroactive, you may want to consider harvesting capital losses if you've already realized significant gains that will push you over the $1 million mark. On the flip side, if the proposal is not retroactive and would go into law on January 1st of 22, you may want to consider harvesting gains in 21 to take advantage of the preferred rates while it still exists, if you're at the risk of paying the 39.6% rates on those capital gains.
Plus the additional 3.8%.
Plus the additional, right?
Net investment tax on top of that.
If you have passive investments that have suspended losses, liquidating those investments to take the losses against your current year income could be beneficial in reducing your ordinary income.
And sometimes I see clients that are sitting on these big, very big passive activity loss carryovers from, sometimes you see them with real estate investments, sometimes it's a venture capital that they went into with a bunch of other folks. And it might not be easy to get out of, but it might be something worth exploring to see if you can sell that interest. It can have, it can have some recapture events too. So make sure you work with us and reach out to us to see what the ramifications are. But I've had clients that had investments in dogs that just sat around and they were waiting for the company to wind up, that if they were able to sell it to somebody else, they might be able to trigger that passive activity loss sooner. And that can really help drive down your adjusted gross income.
Absolutely. And then timing of charitable contributions, it's also a very large part of the plan, especially if you're able to take advantage of the 100% limit for 2021, or it can be as simple as bunching contributions in 1 year to push you over those standard deduction limits.
And
then finally, oh, I'm sorry, Cheryl, keep going.
Yep. With interest rates being as low as they are, we have been chatting with clients about potentially funding, whether it's charitable remainder trust or charitable lead trust. Both of these vehicles produce, the charitable lead trust can produce an income tax deduction potentially. We usually look for philanthropic intent, but so that's a way to get a big income tax deduction in a year. Just a side note, for our New York State residents, New York, as your income goes up, they phase out your itemized deductions, but they also phase out your charitable deductions as well. So we just would want to just explore that with you. But if you do have some charitable intent, there are planning vehicles out there that can make a lot of sense. Even if you have a large capital gain that you might be harvesting. A charitable remainder trust, which is something that you put money in and you get an income interest for life and the remainder goes to charity, that can really help diversify your portfolio. So I guess the key takeaway from the tax planning is, if you have, please reach out to us and just discuss what your ideas are. I can't tell you how many times a client says, oh, I sold this piece of real estate, or I did this. And you go, oh, well, if we would have structured it this way, maybe we could have mitigated some of this income tax ramification that we're now that's going to happen. So please reach out to us. We'd love to chat with you about planning opportunities. That's what we're here for. The compliance piece is what memorializes the planning. So if we have increased tax rates in the future, usually we like to accelerate our deductions and defer our income. We might actually want to accelerate our income and defer our expenses if we're going to have increased tax rates. That's easier for cash-based taxpayers than it is for accrual basis taxpayers. So again, reach out to us, especially as we see where this year is going. I'm sure if big piece of tax legislation passes, that Maria will be having us present again on how to help mitigate some of these potential tax increases, because I don't think there's been a time, Bob, that we've mentioned during our entire presentation today that tax rates are going down. So
right.
There's a lot of planning potentially to convert or to try to reduce your tax liability the best we can.
Right.
And with that, we're going to talk about some estate and gift planning. So where are we currently? So currently, our federal, that's important to note, our federal estate exemption is $11.7 million. Back when I started in 1991, the New York State exemption was $300,000, and now it's currently $5.93 million. And the federal exemption was $600,000. So even if we indexed it for inflation, we would not be at $11.7 million. So these exemptions are significantly higher than I think most planners had anticipated. The Tax Cut and Jobs Act, in my opinion, surprised us when it raised those limits to over $11 million. They were at over $5 million at that point. The highest marginal rate is 40%, and that kicks in at just $1 million worth of assets. The transfers of appreciated property at death get a step up in basis. So we don't have to worry about what mom and dad's house, when they purchased it in 1950, how much it really originally cost them. So the house gets a step up in basis to market value as a date of death. The nice thing about the federal law is this concept called portability. So if we had two individuals, the best way I can explain is if you have two individuals and one individual has $20 million of assets and the other individual has $5 million of assets, and the individual, so together $25 million worth of assets, and on the individual with $5 million passes away and leaves everything to their surviving spouse, you get something called a marital deduction. So they didn't use any of that $11.7 million of exemption. As long as we file an estate tax return and elect portability, that surviving spouse will get that predeceased spouse's $11.7 million exemption. So now they've got $23.4 million exemption. That's called portability. I want to touch on New York State. New York State doesn't do that, unfortunately. And portability came in a number of years ago for federal purposes. So in that same example, for New York State purposes, New York State's exemption is 5.93 million. So if that individual with $5 million predeceased, the $20 million spouse, and they did not use any of their $5.93 million exemption, that's a lost opportunity. So it's very important if your and your spouse's assets are over $5.93 million and you're a New York State resident, that you're making sure that your assets are structured properly and your underlying wills and revocable trusts are structured properly to take advantage of the New York State exemption amount. So I just wanted to mention that here today. So this $11.7 million exemption, I like to refer to it as the enhanced exemption. And the reason for that is it's set to expire back to the pre-Tax Cut and Jobs Act level, starting December 1st, 2026. So we've been working with clients since the passage of the Tax Cut and Jobs Act in chatting with them about using this enhanced exemption if it makes sense and if they're comfortable making transfers in various planning vehicles or gifts outright to their children or whomever, to use this opportunity, as I refer to it, because of the concern that the exemption may go down. Now, with the election of Biden and the Senate and the House now being both Democratic, there's concern that these higher exemption amounts are not going to last until 2026. So that longer length of time that we thought we had for planning, there feels like there's an urgency now that if clients are comfortable that we are doing planning sooner and not letting this potential opportunity pass. And the reason for that is some of the proposals that we talked about before about reducing some of these exemption amounts. So let's just talk about that a little bit further. For the 99.5% Act, or the not for you 0.5% really wealthy clients, lower estate exemptions down to 3.5 million. So even more, even lower than what would happen if the Tax Cut and Jobs Act expired. And limiting gifting to $1 million, not indexed for inflation. So those are backdoor tax increases all the time, similar to the net investment tax of 3.8%. I think the Obamacare passed in 2008. I might not be right on that date, but that has not been indexed since 2008. And so more and more taxpayers fall into that. The concern I have with this lifetime gifting of $1 million is New York State has a very interesting rule with regard to estate tax. They assess the estate tax on your assets as of date of death, plus any gifts made 3 years prior to when you pass away. So from a planning perspective, when I have clients that may be subject to a New York State estate tax, we look at potentially making significant gifts to get them under the New York State exemption amounts. And many times those gifts are well in excess of $1 million. So if we don't do planning for clients that may be subject to the New York State estate tax, and we're subject to this $1 million limitation, we're going to have a harder time getting those New York State taxpayers under the New York State threshold currently. So I just wanted to mention that because right now, that's one of the ways that we try to help clients avoid paying New York State estate tax, because it is a nice planning opportunity. I kind of thought that with the New York State Budget Act that they passed in March or early April, that they would have closed that opportunity, is the way I phrase it, down, but they didn't. So it's still there. However, the 99.5% Act could end up limiting that opportunity for New York State taxpayers. They're looking at potentially increasing that rate from the 40%, and they'd start with a flat 40% rate instead of the current graduated rate that we have now, up to, for taxpayers that have over $1 billion worth of assets, to a 65% rate. So, wow, there's some significant increases for that 0.5%. The IRS has never liked valuation discounts. Those are things for like lack of marketability, lack of control, that are oftentimes that we use for transfers or sales of closely held business assets, or sometimes when we set up other types of planning vehicles, we have discounts involved. The IRS has never liked those, and they've continually attacked those discounts. In this proposal, there would be an elimination of valuation discounts. So a lot of times if we have clients that say have a closely held business worth $1 million and they're gifting minority interest to their children, we're able to squeeze that $1 million down to something less because of lack of marketability, lack of control discount. And those are they're very valuable discounts when we're working on transferring value to family members. And then the other interesting proposal is generation skipping transfer tax. This has been in play for quite some time. It allows a taxpayer that has $11.7 million worth of assets to transfer assets up to $11.7 million to their grandchildren and skip a generation. But over the years, since I've been practicing, we've been seeing a significant increase in the number of clients setting up trusts in places like Delaware, South Dakota, Alaska, that have things called dynasty trusts. There isn't a term on the trust like New York state law has, which is life and being plus 21 years. And what the IRS is kind of saying, and this 99.5% Act is saying, is to put assets in trust that will never be includable in anybody's estate is kind of going against the intent of what the estate tax was. It was meant to tax wealth at increments of time. So there is a proposal to potentially tax the value on these assets that are held in trust every 50 years. Interesting thing to note, Canada has something similar every 21 years. So this is the first time that I've seen this proposed before, but it is floating out there as a potential way to collect some additional revenue to fund some programs. We chatted about the valuation discounts, so I think I'll advance from there. And the generation skipping transfer tax, again, that is really aimed at those dynasty trusts that can stay in trust for 1,000 years. So when you talk to a grantor and you're like 1,000 years from now, these assets may still be held in trust for family members. That's what we're looking at. So polling question number 4. Have you or do you plan to change your gifting to family members in 2021?
Keep it going another 10 seconds or so. Okay, I'm going to end the poll and share the results.
And it looks like most of you do not plan on changing your gifting in 2021. And so let me just, we'll talk real quickly about this potential elimination of the step up in basis. In 2010, there was no estate tax. And so there was a concept called carryover basis, and there was a partial step up in basis at that point in time. So we have seen it in practice just in 2010. So what they're looking at as part of the step up plan is to eliminate that step up in basis. And they would limit it to $1 million of step up in basis and then tax the rest at a 39.6% rate. What would be interesting about this, if something like this passes, is whether they would have both the estate and the income tax applicable at the same time. They seem to be competing for the same dollar. And with that, just a quick example, if they eliminated the step up in basis and we still had the estate tax, there is a concept called a 691C deduction, which eliminates the double taxation of income that's includable in an estate, and then is also taxable when the recipient receives it. And a good example is IRA assets. They're includable in your estate, but your beneficiaries pay income tax on it. If they eliminate the step up in basis and they also have the estate tax, if we didn't have a 691C deduction, which would be very punitive, that would be pure double taxation. On $3 million worth of Apple stock, the family would end up with about $613,000. Under current law, the family would have about 1.8 million. And if they did allow for no step up in basis, but did allow for the income tax deduction for the estate taxes, which quite honestly adds a lot of complication to a lot of people's tax returns, the family would net $1 million. So we're looking to raise revenue. I guess this would be one way to do it, but it seems very punitive at the same time. So some planning considerations. You know, if you're one of those individuals that hasn't looked at your will in a long time, you should review it and reach out to your attorney and make sure you're reviewing those. There's been so many changes between federal and New York State over the years that if you have a potential New York State taxable estate, your will might be worded in a way that is not taking benefit of the New York rules because the federal exemption amounts are so much higher. In addition, if you're somebody that has a potential taxable estate and does gifting every year, you can gift up to $15,000 per donee every year and not have to file a gift tax return. If you gift over that amount, you may need to file a gift tax return, but those exemptions are very, very powerful, especially if you are in a federal taxable estate. And I'll share with you a quick real life example. I was working with the family, and you know, we work with the investment advisor to make gifts at the beginning of January every year. And we made the family, or the individual made $300,000 worth of gifts in early January and unexpectedly died at the end of January of that same month. And because of that, they transferred $300,000 worth of wealth under the annual exclusion gifts. That person has a federal taxable estate. They didn't live in New York, so we didn't have to worry about that piece of it. But the family saved $120,000 in an estate tax because they made those annual gifting. And so often we see clients that maybe they gift to a life insurance trust, but they don't gift before the premiums are due. And they might wait till later in the year to make those annual gifts, annual exclusion gifts. They could fund that premium at the beginning of the year, just put that money in the trust and then pay that actual premium later in the year to take advantage of that annual gift exemption. Really think about your lifetime gifts. It's very important as we, with these proposals, that if you have any inclination to make some gifts, you're in a federal taxable estate, that you're reaching out to one of us so we can just talk to you about potential opportunities for planning. I'm currently working with the family, husband and wife. They have well over the $24 million. And if they make gifts, a proposed gift this year, and then the exemptions go back, we could have very, very significant savings. 7-figure savings by making a substantial gift this year, if they're comfortable, especially if these exemptions go down. So we want to be thoughtful about it, but we'd love to explore with you the opportunities that are currently available, if you're comfortable, just in case these exemptions do get reduced. And as we've gone over today, you can see there's a lot of ways they're attacking to raise revenue on the 0.5% or those earning over 400,000 to meet some of these policy objectives that Biden has. The other thing I wanted to mention, if you have irrevocable life insurance trusts, there's some proposed rules that would be very difficult to exclude. A lot of times we have irrevocable life insurance trusts to exclude those proceeds from an individual's estate. Some of these proposals are attacking that planning mechanism as well. So very important. It's too detailed to get in today, and we are running out of time because we want to keep this within an hour. So please feel free to call Bob, myself, anybody that services your account at the firm, and we'll make sure you get in contact and have a good conversation with somebody that can help you through these very complex plans. And then, final plug for those annual exclusions, you can gift directly to charity or directly for education or medical. You cannot write the check to your child that in turn writes it to the college, but you can pay directly for whether it's your child, for your grandchild's private school education. You can pay for college, you can pay for those braces, but do it directly with the dentist and not through your child, and that qualifies as well for gifts that do not use your gift exemption. So with that, Maria, final thing, there's so many different ways that we can plan. So if you are thinking about it, please do reach out to one of us again so that we can talk about all the various techniques that we have in our tool belt to help mitigate some of these potential income tax and estate tax increases.
All right, Cheryl and Bob, thank you very much. We do have 2 questions, so we'll take a minute. We have about 4 minutes left, keeping this to an hour. So the first question is, what is considered a public charity? A private university?
So a public charity is an organization that receives the majority of its funding from the public. So a private university would qualify, a public university would also qualify. On the flip side, a private foundation is one that is typically funded by one individual or one family rather than the general public.
All right, thanks very much, Bob. And the second question is there a middle ground for capital gains percentages? Should I move to sell real estate holdings given appreciation this year?
So that's something that we would want to explore more directly with that individual. There's potential gain recapture at higher rates of 25% on the sale of real estate. And there's also potential opportunities. We still have the ability to potentially roll those real estate gains into a new investment called the like-kind exchange. And there's actually, if you don't want to actively manage that real estate anymore and invest, but still continue to invest in real estate, there's something called a Delaware Statutory Trust, which would allow you to defer that gain and also still hopefully get an income cash flow as well without having to actively manage that.
All right, thanks very much. So that concludes our session for today. I appreciate everyone coming in and joining us for the hour. As mentioned previously, and I'm going to put it in the chat again, we do have 3 events left in the series, 2 in July and 1 in August. So you can join us for the rest of those. And again, we'll be giving CPE for those who need it. So any questions, you can email Cheryl or Bob directly, or you can reach out to me as well. So thanks again, everyone, and enjoy your Tuesday.
Thank you, everyone.
Thanks, everyone.